What's up everyone, it's Karthik with MoneyVest. So let's get ready for our FOMC live stream. We've got 15 minutes until the statement comes out, and statement and the summary of economic projections are both going to be very, very important for market direction, as we are seeing during market open. It's pretty late here. We got QQQs down about 0.5%. We got the S&P 500 down over 66 basis points as well. We got Nvidia slightly higher, Tesla slightly lower. All in all, the markets are very, very flat. It's been up and down and all over the place over the last several weeks, as the markets have been consolidating sideways, as both Bitcoin and Ethereum are pulling back right now as well. Long time no see. I know, right? It's only been a few hours, but feels like forever. But I've got everything set up. So just to give you a little bit of an idea of what we're going to be focusing on. So this is the Federal Reserve website. You can go to federalreserve.gov. That's the official website for the Federal Reserve in the US. Last meeting, you'll notice, was on January 28th. So it's been almost 2 months that we heard from Jerome Powell. A lot has happened since then, especially in the world of geopolitics. And of course, since then, we've seen Trump do many things in all over the world, in Venezuela, in Iran, in the Middle East. Of course, the conflict continues to escalate, and we're going to find out exactly what the Federal Reserve is going to do, which is most likely going to be a rate pause. I don't think anybody in the world right now is expecting for the Fed to cut interest rates. And the most important thing, of course, is going to be the summary of economic projections. So to give you a little bit of perspective, the last SEP that we actually received was back in December, right? So December of last year. This is the PDF, which I'm going to open up, and you'll notice that in 2026, the Federal Reserve did pencil in for one rate cut. Now, if this number actually changes, right? So if this number actually goes up, if it goes from 3.4 to 3.6, I think that is going to be a little bit of a disappointment to the market. I think the market will probably get repriced, not in a good way. We might see the markets come down if this number right here jumps higher. And that simply means the Federal Reserve is also, along with the market, is not pricing in for rate cut in 2026. So if I show you the CME Fed Watch tool, you'll notice that right now as we sit, we are somewhere between 3.75 to 4% is where we are on the interest rates. And if the 3.5 to 3.75% is where we are, and so if that number jumps from 3.4 to 3.6, that means no rate cuts, because 3.6 is going to put us right in the middle of this range, and that would simply mean that the Federal Reserve themselves is looking at holding rates steady and not cutting down further, which is exactly what the market has already accepted. I mean, they've already priced that in. So maybe it's not such a bad thing after all, but I think it's going to get the Federal Reserve's stamp of approval that, okay, the market is indeed right. We're not going to see any more rate cuts in 2026, at least, not that we've seen them. The last meeting was also a pause, and so we're most likely not seeing any rate cuts if this number actually goes up, and the market is also aligned with the Fed. If they stay at 3.4, actually that could be a positive news for the market, that could actually turn out to be a bit more on the bullish side, because even though the market is not pricing any rate cuts, the Federal Reserve is still expecting at least one rate cut to bring rates down to somewhere between 3.25 and 3.5%. So 3.4 lands right in the middle of that range. And so that, I think, could be a bit more on the bullish side. So my expectation going into this FOMC meeting, we can kind of ignore the GDP numbers, we can ignore the unemployment, we can ignore the inflation, because none of those things the Federal Reserve actually controls. These are just projections. That's why they're called summary of economic projections, because at the end of the day, like, the Federal Reserve is trying to make a prediction of where these things are going to be, and their predictions, their forecasting, their projections are just as good as ours, because at the end of the day, it's all a guess. But what's really going to matter at the end of the day is going to be the interest rate. The interest rate is what's really going to matter for the Fed. So, so that is going to be the important thing, is where the Federal Reserve pins down this 2026 number. and also 2027, right? Because to give you some perspective, right now we're at 3.6. The Federal Reserve told us about a 1 rate cut in 2026 and another rate cut in 2027. So from where we are right now, 2 rate cuts to get this down to 3.1%. But if these two numbers change, the ones that I've highlighted here, that's what's going to move the market. So if this number stays at 3.4, bullish. If this number goes down, extremely bullish. If this number goes up to 3.6, maybe it's a little bit more of a neutral reaction from the market because that's already what's being priced in as per CME Fed Watch tool. But if it actually goes up above 3.6, but I doubt it's going to go up above 3.6 if it does go higher anyway. But if it goes up to 3.8 or 4, then yes, there's definitely trouble ahead for the market because that's a huge increase, which again, I'm very doubtful, like less than 1% probability that this number is higher than 3.6. I could see it get up to 3.6, but not higher than that. I mean, I'd be surprised if it actually gets up to over 3.6. So that is the quick take on what I'm expecting from the SEP, the Summary of Economic Projections, which comes out in 8 minutes. Do me a favor, share this video with as many people as possible, drop a like and subscribe. You guys know the drill. We're gonna reload this page as soon as 2 p.m. hits, and we're going to take a look at the Summary of Economic Projections. So again, do me a favor, share this live stream with as many people as possible, your friends, family, other traders, investors, other groups, wherever it is you want to share that link so we can have more and more people join us and have a very good discussion about what the Federal Reserve is going to talk about and also what the Summary of Economic Projections is going to give us as well. So yeah, that's where we are. The one guy I would cut off listening to Tom Lee to join live. Thank you so much. I really appreciate that. And over 100 people watching, 13 likes. Keep counting away by smacking the like button. Now, yes, I really appreciate that. It's a little bit past 11:20 p.m. By the time the press conference starts, it's going to be well past midnight. So I'll try to stay up. But yes, definitely do drop a like, share this video so we can have more people join us here on this very amazing day packed with Jay Powell's speech. And this is going to be his one of the 3 last speeches as chairman of the Fed, or second to last. So March and April are his last 2 press conferences as chairman of the Fed. So when does Powell end his term? I think it's May. So Federal Reserve Chairman Jerome Powell's term as chair ends on May 15th, according to the official Federal Reserve history in congress.gov. Although his term has expires chair in May 2026, he has indicated he may remain on the Fed's board of governors until his term as a board member expires in January of 2028. So it's probably not the last time we hear from him as a member of the Fed, but yes, as a chairman, only 2 more speeches left for him after 8 years since 2018. Literally my 11 years of investing journey, I have experienced Jerome Powell's as a chairman of the Fed for 8 years of those 11 years. The other 3 years, of course, was Janet Yellen. But yeah, it's an era, right? It really is an era that's coming to an end for a lot of us. I mean, investing, trading really took off substantially after COVID. So after 2019, 2020. So I think Jerome Powell is all we've had to really experience the market. But yeah, he's going to be gone after 2 more press conferences as the chairman. He's still going to be on the Fed's board. But did I miss the poll for color of the tie? That's not a JP relevant thing anymore. I mean, we could do the poll for the tie color. Or do you guys want to do a poll for 2026 number here? So I think this is going to be a lot more relevant for where you think this 2026 number is going to end up. Is it going to be 3.6, 3.4, 3.2? I think that's a much better poll for us because I think that this might increase to 3.6 or it might stay where it is at 3.4. I think those are the most probable. If I were to put any kind of probabilities, I would say like a 40% chance of 3.6 to 3.4. I would say it's pretty equal. And then maybe like a 9% chance that, well, not really, 9 is a little too high. I would say maybe, yeah, I would say like 49, that's 98, that it gets up to 3.4, 3.6. Either it stays the same or slightly goes up. And then 1% chance each that it goes up to 3.8 or 3%. Because those, I think, are very rare probabilities. So let's just do a poll here very quickly. We got over 300 people watching. So 2026 interest rate projections from the Fed. So 3.2, 3.4, we'll put 3.6, and then we'll put 3.8, which again is going to be quite unrealistic. So just to give you some perspective, 3.4 is where we are as of December. So 3 months ago, this is what the Federal Reserve put in. That means 1 rate cut in 2026. The market right now is pricing in for no rate cuts, just a pause across the board for the entire year. And I'm curious to hear what everyone else has to say in terms of that poll for where the interest rates are going to be. Is it going to be at 3.4, or are they going to match the market and move it up to 3.6? If they move it up to 3.6, that means they start matching the market with no rate cuts, no rate hikes, and just a pause across the board for the entire year in 2026. 70% of you guys are expecting for the Federal Reserve to land us right at 3.6, 3.4 again, so pretty much unchanged for this 2026. That, in my opinion, like I said, could be a bullish take on the market there, because that is actually a pleasant surprise. Even though the market is pricing in no rate cuts, the Federal Reserve is telling us at least 1 rate cut is still on the table. Whether they do it or not, of course, time will tell, but it's still on the table. They're still penciling that in, which could still lift the markets higher. So yeah, I think you'll have to rerun the poll again after the new chair speaks. Or is this poll just for today? I think it's just for today. For sure, once we have the new chairman of the Fed, I think the entire landscape changes. Kevin Warsh being in the running, but we'll see who ends up being the chairman of the Fed and what the overall sentiment and just the overall perspective for interest rates is moving forward. Because we know that Trump is going to continue to put a lot of pressure on whoever is the chairman of the Fed to lower interest rates. So anyway, a minute and a half, folks. Minute and a half. 90 seconds left for this statement and summary of economic projections. Again, make sure that you drop a like, subscribe, and share this live stream with as many people as possible so we can actually have a very engaged discussion. We've got the NASDAQ, we've got the S&P, I've got Bitcoin and crypto, and then we'll take a look at gold and silver. The yields, everything is going to be moving in about a minute here as these numbers come out. So less than a minute left. You guys know the drill. We're going to reload this page right at 2 p.m. Eastern. I'm going to open this up in incognito as well, just to make sure, and we should be ready. The first thing we're going to be reading is a statement itself, and it's going to be this right here. It's a 3.5 and 3 3/4. If it stays that means it is unchanged. The Federal Reserve is not cutting or raising interest rates. They're staying where they are. 3.5 to 3.75, right? 3.5 to 3 3/4 is what we're going to be looking at. So 10 seconds for the statement and the summary of economic projections. We're going to take a look at the statement first, SEP second. And here we go. It is 2 p.m. Eastern in New York, and boom. Let's see, as soon as we come in, takes a little bit of time as it always does. There we go. We've got the statement and the PDF. And of course, as always, there is no page to be found. This happens sometimes. There we go. We're going to try it again. Okay, so this didn't open. This opened. We are coming down. 3.4 is where we are. So they actually stayed put at 3.4. Unchanged is where we are for the 2026. You guys were all correct in assuming, and we are looking at 3.5 and 3 3/4. So no change in interest rates, no change in 2026 expectations as well. So you can see that 2025 has dropped off. 2026 is at 3.4%, exactly where they were back in December. and the market not pricing in for rate cut, getting a little bit of a pleasant surprise that it is still on the table, folks. It's still on the table. We're not done with that rate cut yet. It might still happen sometime in 2026. That's what they're pricing in for. So that's where we are. Again, interest rate remains the same. It's exactly the same. The only thing is the longer run, they have moved up a little bit at 3.1 from 3%. That's it. Inflation expectations have jumped from 2.5 to 2.7. Makes sense because oil prices have been elevated over the last couple of months here. Unemployment rate 4.4 for 2026, slight increase in 2027. GDP growth a little bit stronger over the next couple of years, but everything else is exactly the same, especially when it comes to interest rates. And this is the statement. They are basically holding rates steady, so 3.5 to 3.75. So they are not doing anything. So the committee decided to maintain the target range for the federal funds rate at 3.5 and 3.75, so 3.5 to 3.75. And that's pretty much it. The committee will carefully assess incoming data, the evolving outlook, and the balance of risks. So that's where we are. Markets very, very non-reactive, not caring about the Federal Reserve statement at all. No movement. Absolutely none. If anything, we're actually seeing volume drop for this right now. What's going on? Is nobody trading anymore? Yeah, he's still going to be talking, Kevin. He's still going to be talking at 2:30 p.m. Eastern. So in about 30 minutes or so, he is going to be talking. So, yeah, I mean, that's where we are. I mean, not much change from the previous numbers. And 2026, most members expect interest rates to be well over 3.25 to 3.5%. So that's where we are. And again, majority are expecting for rate cut. Majority of them are expecting at least one rate cut in 2026. Because if you take a look, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So there's 12 of the 18 members or 19 members that are basically suggesting or expecting rates to be lower. There's some members even calling for less than 3% interest rates. That's like more than 2 rate cuts. There's 3 of them. But yeah, majority expecting rates to be lower in 2026 by 1 cut, 25 basis points basically. So yeah, I mean, overall, I mean, this was non-reactive from the market standpoint. S&P 500 is dropping a bit. I mean, it's really just not. It's down 60 basis points. I mean, on a 1 minute time frame, it's literally just flat. It's about as flat as it gets. I think overall the markets have become very, very numb to any kind of economic data. It doesn't move on inflation. It doesn't move on unemployment. It doesn't even move now on Federal Reserve statements and summary of economic projections. It's become a non-market moving event. Now, of course, Jerome Powell, what he says, everything discussed during that press conference is going to be very important. But you know, gold prices sitting at just under $4,900. We got silver also. Last time I checked, sitting at just under $79 a barrel. $79 an ounce here, 77 now. Crude oil sitting at just under $95 a barrel, and volatility is up over 3.6%, trading up to over 23. Bitcoin trading back under $72,000 right now. So yeah, I mean, it was mostly priced in, but the thing that wasn't priced in is the fact that 2026, Federal Reserve's telling us that, okay, you know, don't lose your hope. Don't lose hope here. One rate cut is still on the table. It is still possible. Whereas the market's already like, you know what? We're not gonna price in a rate cut at all. We're just gonna go in with the assumption that we're not seeing a rate cut until 2027. And so I think the Federal Reserve coming in with a rate cut, at least one of them, is good. I think it's overall positive. I think the market is just not buying it. That's all it is. So, and especially when you have moved up your inflation targets. I mean, I've seen the Federal Reserve like do this many times before. I've seen them do this multiple times. Like, you know, it doesn't make much sense. If you're expecting inflation to be higher, how is your interest rate policy the same? Like, you're still expecting nothing from December. Like, you know, you're seeing a 20 basis point increase in inflation, but rates are the same. So I've seen the Fed do that. And this is definitely going to be a question that's picked up. Probably one of the first 5 questions they're going to ask is, your inflation projections went up, but then your interest rates are steady. Is there interest rate hike even on the table for 2026? I think they're leaving a little bit of leeway because if they put 3.4, that is suggestive of a rate cut. They can easily bump this up to 3.6 without hurting the market. They can move this up to 3.6 and the markets might still not move. It's not until after it goes up beyond 3.6 is when things start to become a bit more troubling for the market, because that's where we are now. So if they move up from here, that's an actual hike. Going from 3.4 to 3.6 is not a hike. It's just an increase in their expectation versus going from 3.6 to 3.8. That's an actual hike in interest rate. So so that is the overall take on these summary of economic projections. Majority of members expecting a rate cut, markets pricing in for no rate cuts, and we are in a little bit of a discrepancy. And it's actually one of the first times in like 5 years that I've actually seen the market being a bit more conservative than the Fed. Oftentimes the market's way more optimistic than the Fed. The Fed tells us 1 rate cut, the market's pricing in 2 or 3. I've even seen discrepancies as far as 5 back in 2023, 2024, where the markets was pricing in like 5 rate cuts and the Federal Reserve only told us 2. Those were some crazy discrepancies there. But now it's like the exact opposite. The market's being more conservative, more safe, more risk averse, and the Federal Reserve is the one telling us, okay, don't lose hope. There's 1 left in 2026. So maybe as long as the Federal Reserve rate is above inflation, yes, I mean, true, but at the same time, it's still nowhere near close to their target. So 2.7% is still, much higher than where their target is. So, if you look at BLS.gov, and if you come over to the Consumer Price Index, obviously we're nowhere near close to where the Federal Reserve wants inflation to be. So, if you look at the overall chart, I mean, obviously this was 2022, very, very high inflation numbers. And then we've just been flirting around the 3% mark. And right now we're at 2.4, which I guess is not the end of the world. It's been averaging down to 2 to 2.5, 2.4%. So not terrible. Of course, we've come down quite a bit. And this is not, this is more like disinflation, where prices are going up, but they're going up at a lower rate as opposed to prices going down. Prices are not going down, right? This is not, when you see numbers coming down like this, the first thing that comes to mind is like, okay, prices are going down. No, they're just going up by a lower rate. Before we had 6% year-over-year increase, now we only have 2.5% year-over-year increase. So obviously prices are going up, but just at a lower rate. So, okay, so Jerome Powell in about 20 minutes or so. So we've got a very important press conference. Well, I keep saying important, but the market doesn't seem to be moving at all on any of this. Mostly priced in. But in the meantime, let's just cover some fundamentals, technicals, any questions that you guys might have. Happy to go over that for everyone. So let me know if there's any questions that we can answer. New chair leans to a cut at the first opportunity. I think it's going to be all coming from the president. As we know, he's going to be really pressuring the chairman to cut interest rates because it definitely helps the market, helps liquidity, helps the credit flow in the economy. So we'll see what the new chairman of the Fed actually ends up doing. So massive deleveraging event in April. Interesting. We'll find out. I mean, overall, I think margin levels have come down. This is not an overly leveraged market. Maybe in some pockets, maybe in the crypto space. And even then, I think we have seen a lot of leverage kind of flush out of the system after, crypto tanked. I mean, so many traders kind of blew up their account, especially during one of the biggest single day losses for Bitcoin, right? I mean, 13-14% in one single day back in February, dropping over $10,000 in one day. Those are pretty substantial numbers, right? And even back here in October, it dropped like 7%, about almost $9,000 in one single day. So I mean, crypto's definitely seen some pretty wild swings over the last 3 to 4 months and really has flushed out the system like for leverage. So prices that are attractive to add to Meta and Amazon. So let's take a look here. So Meta, I already did share Meta as one of the 7 stocks in the Discord earlier this week that I think are trading at very attractive levels. And, we're going to be watching $5.99 close to $600 for Meta. So anything under 600 makes for a pretty good risk reward ratio for Meta platforms. And then for Amazon, we're going to be watching, I think sub 200, 190, closer to, 195, 196. And then also this green rectangle around $205, $204 makes for a pretty solid trade or pretty much DCA opportunity for Amazon at those levels. Hi Karthik, can you please do an analysis on Netflix? Do you think it'll go down to cover the gap at $85? So Netflix, my shares are sold at $85. I collected that premium and I had to say goodbye to my Netflix shares because I was in the money. And so right now we're validating that support very nicely at $93, $94. So if I bring up my technical analysis, this is the support that it's holding up really well. If it does break down below this, then yes, I think $82, $83 is a possibility. I think we could see Netflix get down to those levels. But right now, this support is holding up really well. Resistance is going to be at 99, close to $100. So that is going to be that resistance with that support level, as I said, around $93, $94 for Netflix. I think we chop till war ends, then summer rally. Yeah, so I think this has been market consolidation and a very, very choppy market. It's been whipsawing back and forth. This is what a kangaroo market looks like. Quite literally trading in a range. Just been moving sideways on very low volumes. I mean, volume's really been down for a lot of individual stocks. And overall price action also very, very flat. So yeah, until the conflict clears up, until there's more visibility from the market, from investors, I think it becomes a very difficult proposition for the markets to rally higher if there is no visibility. Think about it. Like, where's that momentum going to come from when trade routes are blocked, oil is moving higher, there's supply disruptions, there's ongoing conflict in the Middle East, there's massive tensions between the US, Israel, Iran, the Gulf countries, so many other countries getting involved. Like, there's close to 20 countries now involved in this conflict. The UK, Australia sending air defense systems to the Gulf. I mean, investors everywhere are just waiting for this to clear up. There has to be some resolution. We experienced this back in October. It was a 12-day war, conflict between Israel and Iran. But this time around, it's in a full scale with the US directly entering. Some speculation there might be troops on the ground. Iran attacking the Gulf countries, other countries putting in air defense systems. So this is a full-blown conflict that continues to put a lot of pressure and uncertainty among investors. So I agree. This continues to consolidate and chop until we have a clear basis of where we are going, where this is going to end, this entire conflict. So, okay, let's see. Make it hard again about HIMS. Federal funds rate hit 19-20% in March 1980, and people bitch about 3%. Yeah, but you also have to consider about prices, affordability, all those things matter. Do they not? What about the average hourly income versus cost of goods sold? If you look at wages and you talk about 1980s, right? If you look at prices versus wages, prices have gone up 20, if not 30, 40, 50 times more than average income or wages. So borrowing cost at 20% at significantly lower prices is not as detrimental to your financial health, especially when your incomes are good in relation to the cost of goods sold, like inflation basically, versus now when prices have gone up so much that even a 3%, 4% interest rate can be very damaging at a really, really high price. I mean, affordability is almost impossible. I mean, look at some of the major cities, right? California, New York, Boston. I mean, prices are insanely high. So even at 3 to 4%, that makes a huge difference, especially when you consider earnings have not gone up or kept up with the increase in asset prices. So asset prices really depend on demand and supply, right? I mean, it does kind of cater to the top quartile of income generators and asset managers and wealthier people. But then affordability really comes down to interest rates and average hourly earning, like overall incomes. So, that analysis doesn't hold any weight, because you have to look at everything in relation to everything, right? So 19-20%, sure, interest rates were high, but look at the prices. I mean, you could buy a home for $30,000, $40,000, $50,000, right? Now you won't even find a parking spot, let alone a lot. You won't even find, if you put $50,000 on Zillow in Boston, you would get a parking spot. So, I mean, you could disagree, but you can't disagree with data. Look up how much prices have gone up versus how much incomes have gone up. And I bet it's going to be more than 20, 30 times. Prices have gone up significantly more, by a factor of at least 10, if not more, than incomes over the last 40, 50 years. 110%. There's been multiple studies on it. Definitely do check it out. And definitely do study the data, because data is what's going to tell you everything about it. So when is Jay Powell coming? Jay Powell is going to be coming in about 13 minutes. So 13 minutes is when we are going to have the press conference from Jerome Powell. So 13 more minutes and we're going to have Jay Powell on board. Purple tie, give us a little bit of insight into where he sees interest rates and inflation going. I'm sure there's going to be a lot of questions around the conflict in the Middle East, and especially about the commodities market over oil. And I think this is going to be quite an interesting meeting, because Jerome Powell always kind of shies away from talking about fiscal policy, so he never likes to dive deep into fiscal policy. He did not talk about tariffs, whether they're good or bad. But I think this is something that he can relate to, because it directly affects the commodities market, right? So oil prices moving higher is directly going to be impacting inflation, which he can certainly talk about. I think it's going to be quite an interesting conference, kind of understanding his perspective on inflation and interest rates moving forward, especially when it comes to the conflict that's in the Middle East. So yes, I still do hold NVIDIA. NVIDIA is still one of my larger equity holdings in the options portfolio. So it's probably going to give the markets a slap in the face. The near-term horizon looks bumpy. Yeah, I mean, it looks pretty uncertain for sure. And that's why the markets look like this. I mean, we haven't seen anything. We've just been trading down. It's been a little too boring, I guess. But that's also good. I mean, markets are cyclical in that fashion. Sometimes are exciting, sometimes are low volume and pretty boring, but that's what makes the market. So he equals JP. Yeah, I got what you said. So Jerome Powell. All right, 13 more minutes, 11 more minutes. Volatility's pushing up over 5% right now. Crude oil, Bitcoin, Ethereum. Ethereum is also down, trading down to $2,200. Any other questions before we switch over to Jay Powell? We got 10 more minutes. Let me know. And happy to go over individual stocks, fundamentals, macros, technicals, anything you want to discuss. I am happy to go over it for the next 10 minutes here. So what is my take on Lulu after the earnings? So let's take a quick look here. So Lululemon up over 5%. The stock, of course, has been struggling quite a bit, selling off aggressively. Support level is going to stay put roughly around 156, 157. I do think that it does make for a pretty decent swing trade. There is a little bit of capital accumulation, L3 banker oscillator, suggesting for some big buyers stepping in. So yeah, I think there's a pretty good case to be made here for a decent swing trade. 192, 193 resistance, all the way up to as much as 223, 224. And that's going to be a 38 to 40% potential upside for Lululemon. With a support level that's going to stay up roughly at 156, that's a 4% downside for a nice 30% potential upside for Lululemon. So MU stock after earnings today, will it be a buy? I think Micron, SanDisk, a lot of these memory chip stocks have just been very, very overbought. Earnings are coming out, of course, and sure, if they beat earnings, if they come out strong, knocking them out of the park, there's a possibility that it does pump higher. But given how much is already pushed up and the fact that expectations are going to be high, just to be a little bit more careful. That's it. It's now at 43, 44 times earnings, 12 and a half times sales. Earnings have exploded for sure. I mean, if you take a look at annual earnings, they went from like $8 to $38. That's 4 times, more than 4 times the growth there. 16, 24, 32, almost 40. So we're talking almost 5 times increase in earnings, and that's being reflected in the stock price. So how much is already priced in? Is the valuation justified, given the earnings? That's what we have to look at. So, I'm not touching Micron, of course, at these levels, but if it does drop back down to 360s or possibly in the 270s, I would be very interested in it. Vault, yes, you were asking me about Marvell, right? Not only technical, but fundamentally speaking, I think they're on a layer of AI that is yet to be hyped. So let's take a quick look at Marvell. And so a lot of consolidation sideways. And if you take a look at earnings expectations here, we're looking at $3 growing up to almost $9. That's a good 250, 300% growth there. So yes, revenue expected to grow from like 10 to 20 billion. That's a good 100% growth. Earnings expected to go like 250 to 300%. Valuation's actually quite reasonable, 29 times earnings, a little under 10 times sales. And you've got about $2.4 billion worth of debt, more debt than cash on the balance sheet. So I think it's definitely, in my opinion, a growth stock. If you were to do a very simple fair value calculation on Marvell, so we're going to come over here, fundamental analysis, analyst estimates. So we've got a buy rating, 0 sell ratings, 48 of them, and 37 are buy, 11 holds and 0 sells, with an average target of 120, representing about a 36% increase. We got a CAGR of 25% over the next 5 years, which is very strong. So if you do the analysis there for Marvell and grow them at, let's say, even at 20%, the P multiple of, let's say, 25, 2% share dilution, calculate, we're looking at the stock trading at fair value. So Vault, that is, I think, your answer there. That even at 20% growth and a 25 times P multiple, Marvell would be considered at fair value, $87, $88. So not bad. I mean, this is a stock worth looking at, especially since it's been trading sideways. And at lower prices, that's even better at $76. So if you take a look at our matrix, where is $76, right? 76 is going to be right here somewhere. We're looking at 80, 72, 73, 74, 74, looking at 78 here. So 29 times multiple with a significantly lower growth rate, 14%, or 18% growth rate with a 23 times multiple, or 25 times multiple with a 16% growth rate. So all of them actually land us at pretty realistic numbers. That at $76, I think the upside potential for Marvell increases and actually becomes undervalued at those price points. So that would be my quick take on Marvell. Okay, just a couple more minutes here. Could you please let me know a good entry point for Visa, please? Yes, so Visa has also been selling off. I mean, all payment network companies have been pulling back quite a bit. And Visa is indeed part of the shopping list as well. I would put down 285 as the next support. And, if you do some analysis on Visa here, I think this is also a pretty decent growth company. And let's just quickly take a look at where we're going to be for this one. So 39 ratings, 36 buy ratings with a low target of 160, average of 377. That's insane how wide that range is for Visa. But we're looking at a growth rate of 13% CAGR. And so if you look at the multiples of around 32, right now it's trading at 32. So if you put in a 12% growth rate and a lower multiple, let's say 25, and a 2.5% share dilution, we're looking at a fair value of around 265. So 265 is where we are, and that is going to be a little bit lower than my 285 support. So call it maybe right around here somewhere. So, and again, 270, 265, even though those are the fair values, that doesn't mean that we cannot start positions given how much it's already sold off. So I'd be looking at 285 as a pretty good entry point. That's going to be down like 23, 24% in a bear market, and then being a lot more aggressive at 270, 265, down to as much as 250 levels. So the lower the price gets down to, the better the risk reward is overall for these stocks here. Okay, just a couple more stocks here, and then we can switch over to the Jerome Powell speech, and let's take a look. So Marvel we covered. I just need a technical analysis on ETH. It's still stuck in BMNR. So let's take a look at Ethereum. A big drop today, down over 5. And I would say the support level now is going to be here at around 2150. 2100, 2150. That is going to be that support. We were consolidating sideways for a really long time. So after this entire sell-off, ETH was just trading sideways. Then it broke out, revalidated that support. And usually that does happen. Once any stock or technical pattern breaks out, it retests that level and then starts to move back higher. So 2700 would be that next support, next resistance once you validate this support right here. So it's possible that you can validate this level and then of course start to move back higher. $2,700 being that next target and that next resistance. All right, couple more minutes left. We've got this open. We're going to maybe minimize this a little bit and then set up the whole screen because we want to keep track of the markets as well. So we're going to minimize that a little bit more. Perfect. And I'll do an audio check. So let me know if the audio is good. And then we should be good to go. Purple tie is it. It is going to be, in my opinion. Audio's good. We'll just do a audio check shortly once the press conference starts. In about a minute here. One more minute and Jerome Powell is going to take the stage. I'm going to end the poll here. All right, everyone. Jerome Powell press conference starting his second to last speech as chairman of the Fed. Share this live stream with as many people as possible so we can listen in to what Jay Powell has to say about everything. Monetary policy, interest rates, inflation, economic growth, tensions in the Middle East, oil prices, commodities, everything. Quite an important speech here. I'll keep the S&P 500 here and the QQQs, of course, on the left. And we got some individual stocks and crypto and gold and silver all trading over there. Let me know if the audio is good, okay? One more minute to go. Second last speech. I'm a little sad, to be honest. I'm going to miss JP. Yeah, I mean, he's been chairman of the Fed for 8 years, man. 8 years. As I said, I've been investing for 11 years now. So 8 of those 11 years, I've only experienced Jerome Powell as chairman of the Fed. Like some of our older members, like Kevin, for example, he's been investing for 3 decades, I think, or 4 decades or something. So he's probably seen everybody. Paul Volcker, Jerome Powell, Janet Yellen. I mean, the list goes on, right? So many chairman of the Fed members that have come and gone. So, yeah. I hope he wears Jerry Garcia tie for his last meeting. Correction, Kevin has been trading for 7 decades, 70 years. How old do you think he is? I hope he's not watching right now. They're just making fun of him. It's crazy. Seven decades. He's been investing longer than Warren Buffett. All right, here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? I'm just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially it is that, the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods. And on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
That consumers are going to be potentially diverting money to gasoline
Yeah.
from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. To your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that, just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past.
Yeah. So there'll be an offset.
Offsets, yeah.
So that's true. We're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable, and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period of time, meaningfully higher. So I wouldn't say there's much of that happening. Not much of it happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment, and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that, having looked through tariff inflation and inflation running above target, and looking through the oil price shock, would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision-making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had, we had the tariff shock, we had the pandemic, and And now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations. And so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And, I think it's important that we do that, very important.
Nick.
Nick Timmeros, The Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well, as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers, on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, the year before tariffs came in, it was 0. And it's running at like 2% now. So, and so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive, restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services, but we're not seeing progress there. So we do, what we expect for next year is what we want to see for this year, rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Edward.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
You know, it's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and, you know, in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, you know, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you know, you can we're at 3.0% core. Inflation 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time. And that's a concern. You know, we need to get back down to 2%. And we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
You know, it's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply-side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. You know, in a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think a good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent, really, growth in the labor force, which, of course, we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now, that's balance, okay? But, I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So, we look at that, we see it, we get it, and I mean, everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless, it's something we're watching carefully, and so are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless, something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking account of the risk of supply shocks as a more common problem?
We did go through a long period where the shocks were all demand shocks, and so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years, for sure. And it's just a very different thing, and a much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But, has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but I guess, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy the possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case, and of course we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the Strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business services as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there's tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. When we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's 1 percentage point above that. So calling that stagflation, it's not. I would reserve the term stagflation for a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth.
Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do, but in this case, we're going to learn a lot because we're going to learn 6 weeks to the day till the next meeting. And, we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves with what happens in the Middle East. That's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023 when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year, they should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I think that the theory is probably right, but as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. So I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing, as our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history, and then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc. And for all the tariffs, they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases. And we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But the administration said they're going to move they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Chris Rugaber.
Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change based on events. Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction. And so I just think we do it. And, I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think. But we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual good to take the forecast with a grain of salt, because subject to just very high levels of uncertainty.
Brian.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, there were big price increases all around the world, by the way. Everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet, and it will take some years of positive real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed, and there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and what it does for us is makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and stable prices is half of our mandate. It's one of our two mandates, maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States anywhere in the world, in a market economy, in a democracy, and you'll see, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Richard Escobedo.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or specific answer on the first question. You know, we're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. You know, in terms of diesel prices. So your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, you know, the cost of food and other goods that really rely on it to
so
move
I think
across the country.
it's a more general concern than that. It's diesel prices because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that and we're watching it, but you know, we're right at the beginning of this and we don't know how big we just don't know how big this will be and how long it lasts. You know, it may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP and noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, well, I think it's just productivity. You know, we actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of, you know, generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So it's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time. And so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that. And just briefly on that as well to finish up, you hear the argument a lot, this is a sort of disinflationary story, and if you believe that productivity thing, that should also weigh down inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really is the demand growing faster or slower than the supply side? And I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
All right, everyone. So that's it. That was the press conference. Jerome Powell, once again, being a little bit more diplomatic, not commenting on a lot of things, but also talking about the fact that there is a lot of uncertainty, him not knowing what the future holds, and them being modestly more restrictive with interest rates, and then expecting for those tariffs one-time effects to run off and for inflation to actually move down, and being ready to of course do what's appropriate in case oil prices continue to rise higher. Markets are down. QQQs are down almost 1%. We got the S&P 500 down over 1% as well. A lot of individual stocks are rolling over, and volatility is now up almost 7% as oil prices trade over $96 a barrel right now. As you can see, I'm pretty beat. I am absolutely exhausted. So thank you so much for joining. Yeah, whenever I get caught drinking on the job, I also say it's water. It is quite literally water. You really think I'm going to be chugging alcohol like that? This is literally water, man. Like, I have this at my desk at all times. But yeah, thank you so much for joining. As always, appreciate you. Make sure that you drop a like, subscribe, and again, link's gonna be down below if you're interested in joining. So defensive. No, I'm not. I'm not. I'm literally not. But anyway, thank you so much, you guys. Take care. I'll see you all in the next